Welcome back, finance fans. In this video, I will discuss 5 important principles for investing during a recession from the greatest investor of all time, Warren Buffett. Buffett famously said, "Be fearful when others are greedy, and be greedy when others are fearful." What does this mean? Let's break it down into 2 parts. Be fearful when others are greedy. When markets are booming, and everyone is rushing to buy stocks or other assets, prices often become inflated beyond their intrinsic value. This is when Buffett advises caution, because greed can lead to speculative bubbles and overvalued investments. Avoid chasing hot investments or following the crowd during market euphoria. Be greedy when others are fearful. During market downturns or recessions, fear often drives prices below their true value, as investors panic sell. Buffett sees this as an opportunity to buy high-quality assets at a discount. The key idea is to take advantage of market pessimism to invest in undervalued companies with strong fundamentals. In 2008, during the global financial crisis, Buffett invested billions in companies like Goldman Sachs and Bank of America when fear dominated the market. These investments were made at steep discounts and generated massive returns as the economy recovered. This famous quote by Warren Buffett shows his contrarian investment philosophy, which encourages investors to act opposite to the prevailing market sentiment. Avoid speculation and stick to fundamentals. Warren Buffett's principles for investing during a recession emphasize a focus on quality companies with strong fundamentals. He warns against speculative investments. Buffett advises investing in high-quality companies during a recession. These businesses typically have reliable revenue and earnings, a strong balance sheet with low debt, long-term growth potential with competitive advantages. Buffett invested heavily in companies like Coca-Cola, Apple, and American Express because they had strong fundamentals. This reflects his preference for businesses with reliable profitability. Speculation involves betting on short-term price movements or market timing without understanding the underlying value of an asset. Speculators often rely on hype, rumors, or trends, which can lead to emotional and irrational decisions. Buffett avoids speculative investments because they are unpredictable and carry high risks. By buying undervalued assets and avoiding speculation, investors can turn economic downturns into huge wealth-building opportunities. Have a long-term perspective. One of Warren Buffett's most famous and successful investment principles is focusing on the long term rather than chasing short-term gains. This approach emphasizes patience, discipline, and the power of compounding over time. Buffett believes in buying high-quality businesses with strong fundamentals and holding them for years or even decades. He views stocks as ownership in a business, not just buttons on a screen to trade for quick profits. Market volatility, news headlines, and short-term price fluctuations don't matter much to Buffett if the company's long-term prospects remain strong. He said the stock market is a device for transferring money from the impatient to the patient. Long-term investing allows your returns to compound, significantly growing your wealth over time. For example, investing $10,000 at an annual return of 10% grows to $16,000 in 5 years. In 20 years, it grows to $67,000. He famously said, "If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes." Invest in what you understand. This principle emphasizes investing only in businesses, industries, or assets you thoroughly understand. Buffett believes that straying beyond your circle of competence leads to unnecessary risks and poor decisions. Buffett avoids complex industries like cryptocurrency and most technology because he lacks expertise in these areas. He invests in straightforward businesses like Coca-Cola, insurance, and railroads because he understands their models. He said investing isn't a test of intelligence. It's about recognizing your limits and staying within them. The best investments are often in businesses you can explain to a child. Warren Buffett has repeatedly advocated for low-cost S&P 500 index funds as the best investment for most individuals. It provides diversification. You get exposure to 500 of the largest, most stable United States companies across different industries. Low costs. Index funds have minimal fees compared to actively managed funds. Consistent growth. The S&P 500 has historically returned about 10% annually over the long term. In 2007, Buffett made a 10-year $1 million wager that an S&P 500 index fund would outperform a selection of active hedge funds. He won that bet by a mile. The S&P 500 returned 125.8% over that time period. The hedge funds returned 36.3%. He said a low-cost index fund is the most sensible equity investment for the great majority of investors. Warren Buffett, one of the most successful investors in history, has shared timeless wisdom about investing during economic downturns. His principles emphasize staying calm, focusing on fundamentals, and viewing recessions as opportunities rather than threats. By following these principles, investors can turn economic downturns into wealth-building opportunities. Thanks for watching. If you found value in this video, please like and subscribe. Until next time, keep earning, keep saving, and keep investing.